Hello traders, today's the 3rd of May. My name is Hornsey, market analyst YouTrading, and today I'll be looking at Bollinger Bands. Okay, Bollinger Bands are an indicator that you can put over your price action, and they just help you sort of see where the volatility is, the compression and the expansions are. So it's just a quick visual and also maybe a filter for you for your trading if you're looking for breakouts. We're looking for an area of compression, which is where price goes sideways into a range, for that range to then break out to the upside or downside, and for volatility to sort of move into momentum, and then for a trend to build off the back of either accumulation or distribution. So Bollinger Bands are great at describing that. This is the chart we're going to build. So I'm just going to sort of delete all these indicators and then show you where to find them. So if you go to indicators here, type in Bollinger, and then you've got 3 to choose from. So you've got the actual bands, you've got percentage B, and then you've got width. Now the width describes whether or not the Bollinger Bands are diverging or converging. So when they're diverging from each other, their expansion, you see the Bollinger Band width expand as well, get higher. And then when they come together, when they compress, when they sort of converge, that's when you see this slope come down. And then when we go sideways in the range, everything's flat. Now, the Bollinger Band percentage B, BB percentage B, when we see price action here underneath the 0 signal line or above the 1, that is relating to closes below or above the upper or lower bound of this Bollinger Band. So if you were to take off the Bollinger Band here, you could quite easily describe what's happening within the Bollinger Band. Here we can see that we had prices come back below the Bollinger Band lower bound, and then we saw the Bollinger Band itself expand all the way through to this candle, and then from this candle, price action around the Bollinger Band moved back inside the lower bound. That's when we started to see the Bollinger Bands start to compress. So even without Bollinger Bands on there, we can describe what the Bollinger Bands are doing. So if I just put them back on, which means we don't really need this these two. It's just whether or not you want to keep your price action charts clean, or if you want to use maths. So today, what happened? We had the RBA come out with a rate hike, so 0.35%. The expectations were for 0.25% at 5:30 in the morning when the RBA announcement came out. We had a big spike up, and then it rejected the level. And if we look to the left, we can see here we had some sort of expansion, some sort of volatility, then a lack of volatility as this sort of grinded higher, which then went into more volatility, like I said here, from this breakout. So if we look to this candle here, 29th of April 2022, 3:30, so that's after the first hour of trading in the US session, the Australian dollar weakened, most probably because of what was happening with the US dollar. So there would have been a lot of stops above this red candle. And if we look to the right, today's price action is what cleared those stops, and they used the RBA announcement to do that. So when we're looking for a breakout trade, we're looking for a period of compression. So we want to see the Bollinger Band width flattening off. We then want to see a signal candle close below or above the Bollinger Band. So we're looking for a move below the 0 or above the 1 on the percentage B. And then we're looking for a risk to reward, ideally of 1 to 2. So if we were to just go short the low of this candle and then drag out 1 to 2, we can see here that 3 o'clock in the morning on 2nd of May, we didn't get down to a risk reward of 1 to 2. 1 to 2 would have us come all the way down here. So anybody that was short from here might not have actually hit profit target. The idea, I guess, may have been to take profits along the way to close out your trade before the tier 1 data. So hopefully if you were short, looking for this trend to continue to the downside, you didn't leave your stop above here before the RBA, you would have hopefully got out. Now, obviously, we had a breakout to the upside here. So if I look here, we had this signal candle. We had a period of compression. Then we had the confirmation that price action had got out of the volatility bands, closed above that. So we're looking to go long. So if I just put a long on here, put our stop below the signal candle low. And then we want to drag it out until we get to a risk reward of 1 to 2. But you can see that we would have easily made 1 to 2, especially on the actual rate hike announcement. That would have hit our profit target. And if we had been targeting the stops, if we were the guys actually targeting the stops above this breakdown candle here, we could have maybe made a risk reward of 4.5. So that would be a good asymmetrical trade if that was the idea, to take a breakout, look left to see where the stops could be, either here or up here at this significant swing high. So that's good. Traders would definitely made their money if they were doing it on a percentage basis. That's what we're looking for. If we go back to the previous RBA statement, 1st of March at 3:30 in the morning, we can see that we had a spike lower than the Bollinger Band, didn't get a close below. Percentage B didn't confirm volatility had expanded to the downside. However, we are still in this compression, this sort of range. We're seeing that the band width is still going sideways. We got a long opportunity, if you like, here on this breakout. So if we put our stop below the 20 period moving average there, and then actually see where we'd have got to, we would have made a risk reward of 2 just by doing that. But the context was that at 3:30 in the morning, RBA statement came out, rate hike kept as is, so 0.1%. Slight disappointment in the markets, saw prices push lower. You might have seen traders put their stops below there once they sort of saw price action going higher. We then saw at 4:30 at the London close that day, just price action just sweep that low and take that liquidity. So having context, having a reason why there is a compression, why there is a range, and then why we see an expansion. Obviously, anyone that had got short here, got trapped, might have put their stops above this significant swing high here in compared to the rest of the range. Come 6 o'clock in the morning, those traders took advantage of those traders that were trapped, or these traders just puked their position, and that's when we saw volatility expand to the upside. So that's what we're looking for in terms of range breakout trading. That's why traders generally use the Bollinger Bands. This Bollinger Band percentage B can help you along with the Bollinger Band width. You don't actually have to have the Bollinger Band on your chart, or you can just use the Bollinger Band and just look for these areas of compression and looking for a leading indicator for an expansionary sort of signal to go long or short. Here you can see the actual downside move after a period of compression. So we had Bollinger Bands tightening up after this volatility was rising. Then we had a big volatility spike to the downside, and then a continuation of momentum, which led to sort of, some sort of trend. We should also note that if we're looking for breakouts, we also want to make sure that we're not just traveling into supply and demand. So if we look here, we had this green candle, which then led to a sell-off. So there's obviously, as these buyers were coming in on this breakout, lots of other traders were selling into them. Once we got to this particular candle, that's when we're seeing anybody that had their stop up here get that stop taken. So that's when we see a volatility breakout. So in terms of looking for supply and demand, if we look to the left here, we had these guys, last of the green candles were buyers before a big sell-off. So if we look to the right, then once we get price action back up here, we see we get a close here. So that means we see a retest of this old resistance acting as support, and then that is a valid breakout as well. But obviously at this time of day, coming to the end of the London session, obviously volume started to drift off, and we saw sideways move into that RBA. So again, even if you see a breakout and it's valid, you have to make sure you know what's coming down the sort of calendar, making sure you're not just going to get trapped into a low volume compression. So again, here we have the volatility leading to a compression. So we had a big move down 7th of March, then a sideways move. We see the Bollinger Bands sort of converging together. We then see a price action try and get back above. So there was a period of not exactly compression, because we didn't get the Bollinger Band width go sideways. We just saw it sort of narrowing. Once we'd seen a period of time where there had been a sideways move here, you see the Bollinger Band flattening here. then we get a volatility breakdown here, and that would be a better risk to reward ratio of 1 to 2 with the risk above the signal candle there, rather than just sort of taking a reversal here and hoping for the best. So the idea is wait for volatility, then wait for a lack of volatility, a compression, a range, and then wait for a breakout of that range. Okay, that's Bollinger Bands for you. Hope that was interesting, and I'll speak to you again tomorrow.